Joining us now, Jason Thomas, Head of Global Research and Investment Strategy at Carlyle. Jason, great to have you on to kind of put a light on this data. So this is something, just to kind of get the procedural stuff out there. This is these indicators are something that you have maintained for a while, and you've tried to kind of knit them to the publicly available data?
Yeah, that's right. So for the last 15 years, we take portfolio company data, as you mentioned, 277 companies. They generate lots of monthly data, revenues, business volumes, order books, backlogs, prices paid, prices received, very often across many business lines. And we weight each of those time series based on their sensitivity to a macroeconomic variable of interest like GDP. So that weighting scheme allows us to really perfectly replicate the macroeconomic variable on a backward-looking basis, and then achieve fairly high degree of forecast accuracy in real time, and then over the next 3 to 6 months.
So let's get to what the latest, freshest numbers are telling us. I guess the headline would be, we didn't get a jobs report for September. What do your data indicate job growth was last month?
Yeah, I think what was most interesting about our monthly data in September was that payroll employment growth implied from the data was only 17,000. So very low. Typically, when you see jobs growth that low, particularly the deceleration observed over the course of 2025, entering the year, payroll employment growth was about 200,000 a month. You would think it was an economy on the cusp of recession or having already succumbed to recession. But that's completely inconsistent with the rest of the data we received, which of course implied GDP growth of 2.7% annualized rate through the end of September. So it's this really very interesting disconnect between what's implied about payroll employment growth and again, broader economic activity.
So you characterize it as a disconnect, which it would normally seem to be, but it also seems to match up perfectly with how the markets have been positioned, right? I mean, it seems as if the premise of where equities are, where rates are, is that the weakening job growth is giving clearance to the Federal Reserve to maybe bring interest rates down to some degree, but into an economy that seems to be growing firmly. So, I mean, are you able to project exactly how much momentum there is on that demand side, on the top line of the economy?
I think that there was a recovery that we saw really in the consumer. And I think a lot of people have focused on higher income consumers. And yes, there is, I would say, about 35% of households who have a mortgage that was originated before 2022. So they're hedged for interest rate risk. They haven't been affected by the higher rates. They're also asset owners. So they've participated, of course, in the equity market gains. But we did see through the credit portfolio about 150 basis point decline in delinquency rates for consumer loans among the bottom third of households by income. So there could actually be a broadening of consumption growth. And of course, you have to make mention of the AI boom. This is the largest concentrated CapEx boom in over 25 years. And what's so interesting about it is just how disconnected it is from the rest of the economy. That is to say that it's not affected at all by higher interest rates. It doesn't seem to be at all sensitized to the fluctuations we see in the rest of the economy. And, people talk about dependence on this AI CapEx. I don't see it quite that way. In fact, in Q3, it looks like AI made a smaller relative contribution to overall GDP growth, even as the absolute contribution continues to grow. It looks like about 70 basis points to GDP growth annualized in Q3.
So, Jason, when you look at corporate investment and corporate spending, there was the expectation that the big, beautiful bill, which provided for bonus depreciation, immediate write-off, 100% of the value of capital expenditures. Do you see any impact from that so far in your companies beyond AI?
Again, I think that there's so much enthusiasm right now for AI. When you look at the construction sector, things look fairly bleak, except for, of course, data centers. There's no shortage of those being constructed today. So with this, again, it's a theme when you talk to management teams. It's, of course, thinking about AI, the pressures to use it, the fears of falling behind competitors. So there's also, I think, signs of growing downstream revenues associated with AI use, which of course, we should hope for, given the scale of capital spending and the need for all that capital spending to earn adequate returns going forward.